Okay, and we are live. Good morning, good evening. Welcome, everybody. Oh, wow, this room is filling up super fast. Hey, Keith Thompson, great to see you in there. Hey, Lara, Lee Gray. Oh, wow, there's so many familiar faces. This is brilliant. Hey, Mark, there's like 20 Marks in there, but I can't say everybody's full name. Oh, this is brilliant. Wow, we're at 100 and wow.
Wow.
Okay, then. So this is going to take probably another 30 seconds or so to fill up. This is tremendous. So
Hey, Kevin Robinson. Hey, Paul Candian. Great to see you guys.
this is Paul Candian made it. He was telling me he couldn't make it. That is so good. All right, brilliant. So we're still coming in then. So just a quick check-in of what's happening and who we've got here today. So all of us will be familiar faces to you. So we have Laurent that's with us as well, and Laurent is a co-designer of the system. Scott will obviously take over, and he'll be speaking a lot more. So Scott, it's just starting to slow down, but there's still people coming in. But I think I'll hand it to you.
We don't celebrate your body when you come now.
Just let me know when we get you over.
Okay. Let's see. It's just starting to. I think we're good now, Scott. We've topped out. Over to you, sir.
All right.
Have a good time. It's time to come together. It's up to you.
Kill that music. That's going to annoy me. All right, guys. So it's my great pleasure to welcome you here. This is finally the Financial Revolution System Delivery and Onboarding Week, and it's time for us to deliver on all of these promises that we've been making to you for so long. And I think you're going to see that we're not just delivering, we're over-delivering. Really, really happy about this. So this is a great day for me personally, and it's a great day for our company, and it's a great day for you because you get all this for free. There's the song that I just was going to play, so let's just pretend I did that. Some of you here today have been supporting me like from before I even have a website. When I was just started out answering questions on Quora, and you've really inspired me to keep building on my skills. You've held me accountable, and I've gotten better and better. And I've re-evolved and reinvented myself many times. Lots of it with the help of my great friend Laurent, who's here today. And I finally made enough trading capital that I'm actually going to achieve my financial goals through investing. Which wasn't certain at all most of the time. And today's the end result of that process. And I'm going to share with you how you can do that too. So today you're going to see the secret sauce behind what the most successful hedge funds in all of history are doing. And you're going to see all the intricate details about how the strategy works and why it works as well. And you're going to understand what makes it everything proof and how it can make you rich, even if Bitcoin goes to 1 million, or if the entire crypto market goes to zero, or if it gets banned, whatever happens. This thing is very, very bullish. And I'm going to show you how you can double your money in crypto this year from our fully automated system where you just press a button and you leave it alone. And lastly, we're going to cover exactly when you can start trading it, our full explanation of how to use it, how to put funds in, how to withdraw funds out, and our coaches who are going to be doing the onboarding process. And just a quick reminder that for you as CSI member, it's all free, no catch, and we've made a lot of promises and we're very serious about keeping it. So this week's agenda, we're having 2 webinars, same time tomorrow, same link. Webinar 1 is how to build state-of-the-art trading systems. And webinar 2 will be on the inner workings and performance of our system, which I believe is the last trading system you're ever going to want to own. And what we're going to do in webinar 2 is an in-depth understanding of how our system enters trades, exits trades, sides positions, manages risks, a really under the hood view of it. We're going to do a deep analysis of our backtests and our real world results. And we're going to talk about what are realistic expectations going forward. We're going to talk about why we have an edge and all the things that might go wrong with that edge. We're going to instruct you in how to use our portfolio management system, which is designed by Laurent, who's a professional portfolio management system designer. And we're going to talk about our 5-year development plan, and we've got lots of new edges to add to this system over time. Now, if you're like me, you're probably a little bit skeptical of crypto at this point. Like, I've made money, and then I lost money, and then I made it again, and then I gave a fair bit of it back. And in my quiet moments, I kind of wonder, is this just a passing fad? Is this just something that's never going to come back? And if you're still that person wondering, if it's possible to get rich off crypto, is that still possible, or is hope still alive? Then that's what today's presentation is, because that's kind of where I think most of us are at. And I think we have to acknowledge the facts and face the reality that our solution has to work in the face of all the bullshit we've been through in the last year. So truth is, Bitcoin's 28,000 this morning, still down 75% from all-time highs. We had Luna collapse, we had Three Arrows Capital, we had FTX exchange collapse. They caught us for a little bit of money. We have the Silvergate Bank, the DCG bankruptcy, the Silicon Valley Bank last week. We've got the USDC DPEG. It's idiotic to pretend that we're not going to get another one. Like we've had so many, this is just the way it is in crypto. So any solution we have to have has to be able to not just survive these kinds of events, but it has to profit from them. And it also has to take full advantage of any bull market, because that's what we're here for. We're here for bull markets. And it is my absolute great pleasure to tell you that we have succeeded. So the yellow line is Bitcoin, and the blue line is our system. Now, you can see that there are times when the yellow line outperforms the blue line here, briefly here. While our system went up, the yellow line really went up. But what we didn't get this. We didn't get this. We didn't get this. We made money when this happened. And we didn't get this last leg down. We just stayed right where we are. This is amazing. This is exactly what I want. This is exactly what we're going to have. We're going to make money and keep the vast majority of it, and then make more and keep the vast majority of it, and make more and keep the vast majority of it. And what I have for you today is the culmination of my life's work. So this is a fully automated, it's a set and forget system that can double your money in an average year. Earns over 100% per year in an average year. And it's called the Financial Revolution System. We've been calling it internally FinRev for short. You press a few buttons, leave it alone, and never look at it again. I shit you not, there is a great chance it's going to double your money this year. It's amazing. This week, I show you exactly how it works, and there's no secrets here. I'm going to show you the engine inside our Formula One race car of a system, so you can see exactly why it's different and how it's better than everything you've ever seen. And after 3 years of research, I finally figured out how to win big off crypto, and not $500 a day. I'm talking about life-changing money. Oh, that's not the right slide. So let me let me tell you a little bit about how we got here. So you might all think of me as a crypto guy, since that's kind of most of what I talk about on the list, but that's really not the case at all. And the reality is I'm a trading systems guy. I'm a system designer, and crypto is just a vehicle to get me where I want to go. So if a new asset comes along that works better than crypto, I'll be all over that. I'll be on it like a fat kid on a mast. What we've discovered so far is that crypto systems are far easier to make work and far more profitable. And if you think about it, the reasons why that is the case, they really make intuitive sense. So it's a newer market. It's got much more inefficiencies. There's more amateurs and less professionals at the poker table. There's much more emotions and a lot of tribalism, and that these whole religious movements where somehow if you sell your coins, you're a traitor to the coin, and you change your profile pic to a cartoon ape to signal that you're part of that tribe. That's just encouraging bad decision making. When people make bad financial decisions, someone else can profit off them, and that's what we're doing here. So crypto just has a lot of really, really stupid people, and they put more thought into their morning coffee order than their investments. So what we find is that everything that works in the old markets just plain works better. So let me take you back in time to this kind of strange chain of events that led me to creating the best system yet. So back in 2007.
Sorry, Scott, we're not seeing your screen at the moment.
That's okay. That's okay. So I just wanted to talk anyway. So back in 2000, you can see my head though, right?
Yes.
Okay, so back in 2007, I made a lot of money in the lead up to the GFC, and then I gave it all back. And the only thing that really saved my ass was going back to system trading. And I started reflecting. I was like, well, if I can't predict it 2008 and I'm going to give back all the money I made, I need to solve this problem, or trading just doesn't work for me. It's like a terrible idea. And so I started a big search for who are the best traders in the world and specifically the best system traders in the world. And there's this fantastic book that I think everyone reads called Market Wizards. It's a series of books, and two guys in the first book I've learned from, and one was called Van Tharp, who I paid a lot of money to and was kind of a grifter, and the other guy was Ed Sikota, and Ed was a serious guy. Like, so Ed Sikota had a serious claim to having the best track record of all time in trading. And what do I mean by that? Well, he wasn't a billionaire. He wasn't even close to a billionaire. And he didn't have the best risk-adjusted returns. His risk-adjusted returns were kind of shit. Like he had 60, 65% drawdowns. But his rate of compounding was just out of control. So this guy verified turned $5,000 into $12 million in 12 years. So he turned a little grub stake into a massive big bankroll. And he ran this trend traders self-help group called the Trading Tribe. And so I started flying down to Sydney to do the Trading Tribe meetings every 2 weeks, and we would do these self-help exercises and work on our trading systems, and then we would stay up late to midnight to ask questions of Ed online. And fucking Ed was problematical. Ed was deliberately obtuse, and he would not be drawn. Like, you would ask him a question about, like a technical question about what's the best, trend signal. And he would say shit like, well, you can try printing out a big version of the chart on a large piece of paper and look at it from the back of the room. And if it looks like a trend, it's a trend. And more than once, I would ask him a very serious technical question about, portfolio management or something like that. And the motherfucker would pull out his banjo. He had this banjo and he used to play trading songs on his banjo. And he would play songs on his banjo about trading. And those were he was just deliberately obtuse. And so he was like this rich guy who was coming off as like, I've made all this money and now I don't want to tell anyone how I've done it. And eventually we all figured it out, right? Like, and it was really simple stuff that he was doing, right? Like, it was very, very simple stuff that he was doing. And when I did it for 4 years, and it actually worked. Like, yeah, it actually worked. I've got a screenshot somewhere in my trading account at that time. Let me just show you. Let me find it. Here we go. Yeah, so this is around August 2014. I started trading there. Between August and January, we started out with 600 and we ended up with 900. So it was a great time for me because I found this thing that was so simple and so beautiful, and other people had made money from it before. And finally, I was doing it, but there was problems. So the problems were not small problems either. So I was trading with a reasonable sum of money, but for every market that you trade, you need to have enough money to make the CME, the futures margin for that contract. And some of these contracts have big margins. Some of the bond contracts are like $10,000 in margin. Crude is like 100 barrels of oil. It's like $7,000 margin. So you needed a lot of money to trade a lot of markets. And I only had enough to trade 25 markets. And trend following works better the more markets you have in it, right? And so I could only do like a thing that was it was a little bit suboptimal. Like, I was getting about maybe 85% of the performance. And the other thing was, sometimes the best position size would be like 1.4 contracts, but you can't do that. You can only do 1 or 2. And so sometimes I'd get a big winner and I had 1 contract and I should have had 1.4 contract. And it was a little bit frustrating that way. And the other thing that was frustrating about it was every single day I had to be there at the market rollover at 6 p.m. Eastern Standard Time. And that was okay when I was living in Australia. It was breakfast time. Then I moved to Thailand and it was 5 a.m. and I had to get up at 4:40 a.m. and prepare for it. And I had 15 minutes to get, and it was a full-time job. Like, I did not for the 4 years that I did this, I did not take a day off. There's a video on my YouTube of me getting really sick in hospital, nearly dying, and I still turned up and did it. You know, when I took overseas flights, I used to have to arrange the flights so they were around, so I wasn't in the air in these times. It was like there was problems with it. And, but I'd found something that worked. And then the next big piece of the puzzle that fell in place was there is a cousin of trend following called cross-sectional trend or cross-sectional momentum, which is the trend that is between different stocks, relative strength between stocks rather than the strength of them in an absolute sense. And I built the automated wealth creation engine, worked on cross-sectional trend. And these things, cross-sectional trend in the stock market earns 3 to 5% above the broader market in general. But in crypto, it just crushed it. It beat it like a stick. It made a lot of money, but also there was problems. So the big problem was that it only worked in bull markets. Cross-sectional trend only works in bull markets. But then, you know, I was kind of figuring it out that maybe I was on the verge of literally the biggest discovery in little guy finance ever. Because little guys can't trade trend following unless you got even with $500,000, it was suboptimal in futures markets. But you can do it in crypto markets because the position sizes are different. And I'd seen that momentum, cross-sectional momentum worked like 10 times as good as it did in the stock market. And I needed something that would work when the market went up and when the market went down. And it was really, really obvious that trend was the thing. And so we went back to the drawing board. Laurent and I teamed up. We hired world-class developers. And I'll be honest, how we started is just by reverse engineering the biggest and most successful and most modern and most sophisticated trend following hedge fund in the world called Man AHL with $154 billion in assets. And that's what we did. And you know, we've improved on it substantially. Then we've been trading it for over 10 months now ourselves in our own accounts. The results have been great. And I could talk about it all day, but I think it's probably time that I just show you. Let me just share my screen again. So we have more data than this. We have going back to 2018, but I've chosen to exclude it because even though the 2018 data is better, it's not really realistic because in 2018, the market was really in its infancy. There were only a handful of altcoins and we don't have a time machine. So I don't think it's, and including 2018 makes our compound annual growth rate go from 107% up to 140%. 107% is good enough and it's more realistic going forward. So the strategy is 100% in the market all the time. It's going long every single coin that we have a positive forecast for, and it's going short every single coin we have a negative forecast for. We have a compound annual growth rate of 107%. We have 2,000% from 1st of January 2019 to 14th of March 2023. We have a Sharpe ratio of 1.81, and we're going to talk about what that means and how it's very good today. Our max drawdown was 28% in that time. But the drawdowns were long. If you look at this log scale, you can see we have long sideways periods, long sideways periods, long sideways periods. This is characteristic of trend following. Our volatility here at full Kelly has been 45%. So we have the ability, which we're going to talk about in tomorrow's webinar, to tune this up or down for more returns, more drawdowns, or less returns, less drawdowns. We have positive skew, which we're going to talk about later today, which is very important. So the more positive skew you have, the more likely you are to, the more positively exposed you are to black swans. And we are positively exposed to trauma events in the market. So an exchange goes down, something breaks, Silicon Valley Bank, we're probably going to go up, not down. We have statistical significance. We have 0% risk of ruin. Our maximum consecutive wins was 8, but our maximum consecutive losses was 10. This is not a particularly high win rate strategy. A profit factor is 1.41. Our average winner is 1.4 times our average loser. The best day was 24%. The worst day was down 12%. The best month, 67%, and the worst month, 22%. Now, we can tune these up or down to your preference. The best 365-day period was 221%, and the worst was -4%. The average drawdown, 5.9%. The average drawdown day is 21%. The average up month is 24%, and the average down month is 2.71%. We're winning only 53% of days, 59% of months, but 82% of 3-month periods, 80% of 12-month periods. We have almost no correlation to the broader market. The beta is -0.04. We have a negative correlation to Bitcoin. So if you're holding Bitcoin, this does something completely different than Bitcoin. It is all alpha. A correlation with Bitcoin is -5.58. Our returns by year, 94% in 2019, 301% in 2020, 59%. Oh, sorry, this is the benchmark. Our strategy did 121, 152, 221, 23, and so far we're down 4% for the year. That's going to change for the year. Now, if we compare Bitcoin, 2019, Bitcoin had a good year, we had a better year. 2020, Bitcoin had the best year ever, we only did 152%, which is still pretty good. The next year, Bitcoin did 59, and we did 221. The next year, Bitcoin lost 64%, we were up 23. 2023, Bitcoin is up 49 and we're down 4% and the year's not over. So now let's look at our worst drawdowns. So our drawdowns are not particularly bad. So these are our worst 5 drawdown periods. They're not particularly bad, but they are long. So we have a 63-day 28% drawdown. We have a 140-day 24% drawdown. We have a 22% 50-day drawdown. We have a 145-day 20% drawdown. We have a 17% 31-day drawdown, and the rest are small and short. Let's look at our underwater plot. So you can see that recently, our average drawdown is, what's our average drawdown? See that. Our average drawdown is less than 10%. And you can see that for the last year, the worst it got was 8.2%. These are our monthly returns. And yeah, I'll be sharing all of these. So let's move on. So let's get down to the nuts and bolts of exactly how we design a trading system. And one of the things that is very obvious when you talk to retail traders is they really get fixated on entries and exits. Like, where do I get in? Where do I get out? What's my price action setup? And the question should really be, what should the price be? And this is the way that a price chart looks. But this is the way that a price chart looks to a trader. So if this is the actual price, and this is what you think it's worth, the real question is it worth more than what it's trading for, or is it worth less than what it's trading for? And this is the way conceptually that virtually every modern quant firm does things. This is how Renaissance Technology, how Citadel, how Jane Street, how DE Shaw, 2 Sigma, AQR. This is how it's done now. And this is not how it was done 20 years ago. 20 years ago, they were using stops and targets like we are. But the modern quant world has moved on. So every single thing they do is, what's the price? What's fair value? If I can buy it less than fair price plus my trading cost, I'm going to buy it. And so if we look at this and we take the difference between these two things, that becomes a signal. So the difference between these two things turns into a signal like this. And it does not matter what the signal is. If it's a price pattern off a Bollinger Touch, which is what crypto salary system is, if that gives us a predictive signal, or if a trend signal gives us a predictive signal, or if we're doing some sort of order book weight market maker thing, or VWAP or a moving average on VWAP, it's all the same. And this is really important to understand. We turn any possible type of trading edge that you have into a signal that looks like this. And this is a game changer. So let's see how this works. So what we have here is we have a 40-period breakout rule. This is the 40-day high. This is the 40-day low. This is the middle. And as it goes down below, the signal turns negative. And as it gets above here, the signal goes positive. And we turn this very simple single period signal into a signal. Positive, we should be long. Negative, we should be short. Zero, we should be flat. Very, very simple. And so here is the signal for what we call basis carry, which is the cash and carry trade, which is the amount you earn if you go short the futures and long the spot on a quarterly future for Bitcoin. And so, you know, we should be long, we should be short, we should be long, and we find that this is predictive in a different way than trend, in a different way than the crypto salary system. Different is good, different is non-correlated. And so how are other people doing it? So what high frequency traders are doing, they're using speed and order flow sneakiness to get a sneak peek at what everyone else is doing first. So they might have a microwave tower that's got a straighter line than everyone else that gets the information 5 milliseconds before everyone else because of the speed of light and the curvature of the earth and all that bullshit. And by getting that information, they know that, oh, there's more sellers on the offer than bids. So the market is not priced fairly. It's probably going to go down a tick. Now, the market makers aren't doing it that way. They're doing like a slower version of the same thing, mostly by working out the same sort of imbalances in the order book. They turn it into a signal where they think fair value is and where they should quote on the bid and ask. So my point is that high frequency traders, market makers, crypto salary system, mean reversion traders, trend traders, carry traders, all doing the same thing. And now stat arb is the type of trading that D Shore and Citadel and Renaissance Technology are doing. What they're mostly doing is taking two instruments that should trade together, gold and silver, Shiba Inu and Dogecoin. And then they're looking at whether those things get out of whack. And the gap, if they should move together, but one's moving faster than the other, then they should eventually converge. This works in stock markets, BHP and Rio Tinto. This works in FX markets, AUD JPY and GBP JPY. This works on commodity markets, gold and silver, and this works in crypto markets too. This is a very solid way to make money, and this is a large chunk of what quant trading is, and they're just turning this gap into a signal. My point is that everyone who's any good is doing the same thing. So value investors taking price to book, price to earnings, some reasonable ratio of what they think a company is worth. And if it's cheaper than what they think it is, they're buying it. And if it's more expensive, they're shorting it. That's what value investors do. It takes 2 decades to play out. Now, fundamental quants generally do 3-month rate of change on economic data. So if you can imagine the point where here gets lower than it was 3 months ago, this is the point where it would say go short. And here is the point where it's higher than it was. Here it's equal and here it's higher, and then lower, and then higher, and then lower, and then higher. And this is how they convert fundamental information into a signal. Rate of change, that's how they do it. It's all the same thing. Now, what we're doing is we're converting momentum, which we're going to talk about in detail today. Momentum plays out on a few weeks to a few months, and we're going to convert that into a signal. So what is my point? My point is that it does not matter what your edge is, whether it's trend, mean reversion, carry, value, order book microstructure, toxic flow, some sort of options volatility thing. What matters, and what really matters, is that you have a reason to believe that the market is too cheap or too expensive. So it's all the same. So throw away all that stuff about what indicator, what entry point, do I enter on a stop or a limit, any of that stuff, throw it away. It's much simpler to think of it, is it too cheap or is it too expensive? So what we did, we built a trading system engine that we can accommodate literally any type of edge we want to build on it. We can accommodate fundamental edge. We can accommodate anything you could think up. We could accommodate discretionary edges on any exchange, on crypto markets, on stock markets, on FX markets, on futures markets. We built the one ring to rule them all. And this, I think, is going to blow your mind. So when we use a continuous signal, we have many advantages. So this is our signal, which is a blend of all these other different signals. It goes positive here, so we go long. And this is just recently in Bitcoin, by the way. And we exit here and get short briefly. And then you can see here, we get back long again, which has worked. So the implication is that when we use a continuous signal, we don't have any need or want the stop losses, targets, or trailing stops. And if you've ever designed trading systems, this is the complicated thing. These are the things that are hard to get right. So we throw them away. We don't need them anymore. So it becomes very simple. When the signal is positive, we go long. When the signal is negative, we go short. When it falls back to zero, we're out of our long position. We don't have an opinion. And this has so many benefits. It's simple and it's elegant. Our back tests are much more predictive because we're not measuring the complex interaction between entry, stop, target. That stuff has a lot of luck in it and it's complicated. Our back tests are much more statistically meaningful because we're only measuring a single variable. It's very easy and quick to add more systems. It's like 2 weeks instead of 2 years. And we don't have unlucky stop outs. So if ever you've had a trade hit your stop loss and then go on to work, it hits you like a punch in the face. We don't have that anymore. And we don't have arbitrary targets. So if I set my target at 2R, that's a nice approximation, but it's still an approximation. What if it gets to 1.9R and reverses? That sucks. What if it gets to 5R and I'm leaving money on the table? That also sucks. We want to take luck out of the game because we are not getting paid to take that risk. We want to take the risk that the most efficient trading system is an expression of our edge. And what are we trying to do? We're trying to take the risk that we're getting paid to take, and we're trying to avoid any risk that we're not getting paid to take. And the risk that it might not hit 2R, might hit 1.9, that's a risk, a parameter risk, but we're not getting paid to take it. Now, the next thing is that continuously moving in and out of positions, you're adding a bit more, subtracting a bit more, subtracting a bit more. This is very efficient in terms of costs than banging all the way in and then all the way back out. You have far less turnover, far less cost, far less fees. And professionals are very, very focused on costs, which are highly predictable, not so much on returns, which are highly unpredictable. Now, every single quant firm that's serious trades without stop losses these days. And this is the big thing that's changed from 20 years ago. They generally regard using stop losses as plain stupid. This is Agustin Lebron, who wrote probably the best book on trading called The Art of Trading, The Laws of Trading, sorry. He is the head of training, or was the head of training at Jane Street, which is a really dominant algo trading market making firm. He was the guy who trained Sam Bankman-Fried. And he writes, almost all the time, desire to use stop orders indicates either a cognitive mistake or a trade sizing mistake. I've never used one and don't plan to. And this is one of the best traders in the world. The guy who trains the people at arguably probably the second or third most prestigious trading firm there is. And why is that? So this is not my slide, by the way, this is from my buddy James Hodge. He goes by the name The Robot James online. He is a fantastic follow, and I highly recommend you all follow him. Our views probably don't change in this sort of jagged fashion. And what we really want is for our trading system to be an expression of our view. What do we think is going to happen? We want our trading system to very closely express what we think is going to happen. So what really happens in the real world is your views probably evolve. You know, you might prefer to be long and you might prefer to be flat. You might not know and you get whips. I don't know. And now you definitely want to be short. And so new information comes in, and new information makes the old information stale. And we want to probably continually adjust our information and our view. When we have an entry and a target, we're stuck on that old information. We've got no way to adjust. It's inefficient. Doesn't make it wrong. It means there's an inefficiency. And by closing that inefficiency, we can improve the performance of our system. So what we ought to do is to work out what position we want to hold in a given coin. And we want to adjust that position up or down as new information comes in and our views evolve. So when do you exit a position? You exit a position when another position is better, and zero might be a better position, reversing might be a better position. And when should we change size? Well, we should change size when we have the wrong size for the level of risk that we want to take. We want to take a certain amount of risk. We want our drawdowns to be a certain amount, and we want our returns to be a certain amount. If we're not positioned so that that's going to happen, we need to change. And so the whole purpose of risk management is to make our realized volatility, our drawdowns and our returns, what's in the box match what's on the outside of the box. We want to get the thing that we wanted to get. And so when we use, 1% per trade, 2% per trade, distance to stop loss, that's an approximation that gets us reasonably close. Like we're finger in the air, kind of guessing it out, but it's still an approximation. We can do better. So what do? We're going to choose our perfect position size today. Here's our signal. We know what volatility is today. Here's our perfect position size. That position size tomorrow might be higher, but we need to add a bit more. It might be lower. We need to take a bit off. We need to add a bit more. We need to take a bit off. Our position size, if we're trying to do things intellectually honestly, and what's intellectually honestly is to keep the position size that matches the risk that we're trying to take and keep the position direction matching our view of what the market is going to do. If something changes, we should change it up. And so continually wiggling up and down, we're always holding the perfect position size. So what this does is it gives us the ability to choose very accurately what drawdown size we want. And the system tries to keep us in a risk trade. It's not perfect, but it's pretty close. And we're going to show exactly how close it gets to nearly achieve that. Now, this is big stuff, right? Like this is the difference between 20 years ago and now. And so most of the stuff that's in the trading textbooks that we have access to is out of date. And this is the stuff that the last 3 years have taught me. And let's recap. Lots of simple signals are better than complicated combinations of indicators and conditions. Simple is better. You can blend many different single variable signals and get a huge increase in performance. And we'll cover that in a moment. And the easiest way of adding more performance is by adding more markets. And crypto is perfect for this because crypto has a lot of markets. And we know this is the way because the all-time grand champion of algorithmic trading is Renaissance Technology. They have a Sharpe ratio of 2.5 and they've returned 66% compounding after fees for 30 years. And their fees are 5% of capital per year and 30% of profits. And so in reality, they've done about 100% a year for 30 years. It's an unbeatable, the all-time grand champion of returns. And no one is even close, to be honest. No one's even within 30% of that. And what do? They trade 1,000 different systems. We've got 36, they've got 1,000. And we've got a couple of hundred markets. They trade over 5,000 markets. So they're not doing anything. The best guys in the world, they're not doing anything different than us. Their entry technique and their signals are all linear regression lines. That's all they use, but they've got 1,000 models and 5,000 markets. And this is the way. Now, this is very, very interesting. So this is our performance multiple increase as we add more markets. So as we go from 0 to 10 coins, we're at sort of 2.3 times 230% increase in performance. By 20 coins, we're at 280% increase. By 40 coins, we're getting up towards 330% increase. By 60 coins, we're over 3 times multiple. And at about 75, we're at 4 times. And you can see that this keeps increasing and increasing and increasing. And what we found is as you extend this out to 200 and 300, you still get, it's a diminishing increase, but you're still getting an increase in performance. So I want you to just think about the implication of this. So we've got something that we know works, trend. We can either try and get fancy with that, make it fragile, get a better version of trend. How likely is it that we're doing better than the best people in the world? Maybe we do, probably unlikely, but far more likely is we fuck it up and make it fragile. Or instead of doing something fragile that might fall apart, we're going to stick with this simple shit that we can absolutely bet our ass it works on. And we're just going to add more markets and more signals. This is the way. So let's look at how this works. So this is a backtest of our crypto system, but we didn't backtest it on crypto markets. We backtested it on 100 different futures markets, which is the largest data set we can get. And these are all our signals. The purple line is what happens when you combine all those signals. So you can see that 1, 2, 3, 4, 5 signals turns into this. This is amazing. And this keeps going up. We add more signals and this line keeps going up and up and up and up and up. And so what is our performance increase? It's a non-compounding backtest to make it easier to see. But by combining these 4, you're getting, if the average one is 200,000 and the final one is close on 400,000, you're getting nearly double the performance just by combining these systems. And there's no limit to it. We can keep doing this. We can keep adding more markets and more systems and more markets and more systems. And this is how it fucking works. And so that was a big backtest, right? This is before 1980 to 2020. Can we trust it? So the question about how much data do you need to trust the backtest is interesting. It's a question of statistical significance. So our Sharpe ratio after cost for this system on traditional markets is 0.95, and on crypto is about double, which is 1.81. So if we have a true Sharpe ratio of 0.4, which is buy and hold investing on stocks or whatever, you need about 33 years of daily chart backtesting to know if something's legit. At 0.5 Sharpe ratio, you need 20 years. At 0.95, you need a little bit over 6, probably somewhere between 6 and 7 years. And at 1.8 Sharpe, let's assume it was only 1.5, you need 3 years of backtesting. So we definitely have statistical significance. We have a lot of evidence that we can rely on this backtesting. Of course, we didn't rely on the backtest. We just went straight to production and relied on our real money results. So this is our 6 different moving average crossover signals. So you're going to see something here. So the gray lines are all of our 6 different signals, and the red line is what they blend into. And when it's negative, we're betting that it goes down. When it's a positive, we're betting that it goes up, and so on and so on and so on and so on. And so what we have found is that a blend of really dumb, simple signals, like I always shout on moving average as a signal. I always thought it's like Fisher Price, my first trading stuff. Like I thought it's so stupid. But it turns out that a blend of really dumb signals is actually as good as me on my best day. And I tested this. So without cheating, I blocked off the bottom part and I wrote, where would I go short as a discretionary trader and I would go short here. Where would I exit that short? I would exit that short here. Where would I get long? I would get long here and I would stay long the whole thing. And then I checked and said, well, what did the algo do? And you can see the algo was within millimeters of what I did as a discretionary trader with the advantage of seeing how it all worked out. So I was cheating, but not cheating on the signal. It was very, very close. The algo did something very, very close to me. And this is very embarrassing, right? Because like, let's think about 15 fucking years, I've styled myself as an expert on price action and chart reading. I've written courses on motherfucking chart reading, and I've taught all of you how to chart read and price action, and I've written so many daily emails on it. And it turns out that I'm just kidding myself, that the vast majority, like 85% of my much vaunted white man magic ability to read price charts, this is just me subconsciously interpreting momentum. So because I've looked at 20, 30,000 charts, I just look at it and go, momentum is up or momentum is down. And my brain just translates that into up or down. And you have no idea what it costs me to admit that I spent a decade of my life learning to read price charts. And this does the same thing better, more reliably, doesn't make mistakes, objectively true, big facepalm moment. Now, I think we should test that. Ian, can you grab someone and unmic them who you think is an absolute red hot chart reader? So who is the best chart reader?
Okay, let me go have a look. Anybody going to put their hand up as I go through?
Who thinks they're real good?
I know that Bret Hart thinks he's quite good, but I don't think he's ready for this one.
Who's a gangster?
Anybody in the chat before I?
What about Coach Paul? Is he here?
I think he is. Yeah. Okay, then. Yeah, let's go with Coach Paul. You'll be back as a panelist.
Okay, let's unmute that. So what I'm saying is that we have 2 points on this left side of the chart where I would like to go short as a discretionary trader, and then obviously the market rallied off the lows, and I want to find a point where I would get long as a discretionary chart reader. So what I'm going to do when Paul unmics himself is I'm going to move my mouse across the screen, and he's going to say short, long at those points. And then we're going to check and see what the algo did. We're going to see how close. Paul's actually a really, really red hot chart reader. He's you ready, brother?
Just a minute. I'm just gearing up.
Just gearing up. You're on the spot, son.
All right.
Okay, so I'm
Short.
Whoa! All right. Where's your next short?
Well, I don't think I see this one coming. Probably about here.
There's yep.
I'll be looking
And where are you going long?
long. Just change colour. Probably at that point there.
I just meant the long off the lows on the right hand side of the chart. I only marked in one.
Long of the lows on the right hand side of the chart. Okay.
In the right third of the chart.
Probably about there.
Okay. Okay, so let's take a look. I only marked. I didn't look at this middle point, so I don't know. But so Paul is 2 bars past the highs. This bar here breaking this support, and he's right here at about level with that. Okay, so exactly the same point. This reduced risk here, so it was slightly different. It was short and it reduced risk at the point and then got it back on. But here, short exactly the same point as Paul, right? And you are level with here, right here, exactly the same point he got wrong. Pretty
Not
close.
happy with that.
Happy with that? So the implication, you spent a decade, more than a decade looking at this. And the implication is that there's a little bit more to chart reading than this. There's some price action stuff. It's not all of it. Like we're seeing trap traders as well and you know, surprises, whatever. But mostly the 80-20 of chart reading is momentum, and it's internalizing the concept of momentum. And so if this is true, and it fucking is, Paul can't look properly and follow properly 200 charts. This thing can. And we know that the biggest increase in Paul's trading performance isn't going to be him getting better at reading this one chart. It's simply adding more charts, adding more markets. Adding more markets is an easier path to increase performance. So if we can algorithmatize this, I don't think that's a word, we can turn this into a signal and have this happen automatically. Well, it's going to be more reliable. It's going to be as good as Paul on his best day, when he's on the spot, when he doesn't look stupid, when he's paying 100% attention. He's going to do it 200 times. He doesn't have to actually do the fucking thing. That's a huge advantage. He can turn it off and come back into a year and it's going to be done for him. This is a big deal. And so why not automate it to make it reliable, repeatable, and scalable? And, you know, no one wants to hear the unpleasant truth, is that when you get good at chart reading, mostly what you're doing is getting good at subconsciously recognizing momentum. And most people will not want to hear this. Most people will be much happier with the comforting lies and the unpleasant truth. Now, let's move on. The next big difference between best practice 2023 and 20 years ago, there's two versions of risk control. Risk per trade, which is what I've mostly used my whole career, or R, and risk per portfolio. And generally amateurs like me use risk per trade and pros use risk per portfolio. And we're going to look at the difference. And risk per trade is okay in some situations when we're trading one thing at a time. It's not bad at all. But the advantage of portfolio-based risk targeting is you can say, I'd like to see 25% annual volatility in my account. Now, what does that mean? Here's how we work out what it really means. So 25% annual volatility equals 25 divided by the square root of the number of trading days. So it's 25 divided by 16 gives you one daily standard deviation. So what that means is that one daily standard deviation means a normal trading day should be about between 0 and 1.5%. Two standard deviations, a move that happens 80% of the time. The biggest move you should have in normal times is 3%, which is a big but not crazy move. That's like a Bollinger Band move. And a move that happens a couple of times a year, 2 or 3 times a year, 3 standard deviation move would be 4.68% in a day. Now, the advantage is that we're not saying anything about the individual trades. What we're saying is about the thing we actually care about. Like, no one cares how many are you down. What we really give a fuck about is how much is my account down? How much is my account up? What are the odds of my account being down and what are the odds of my account being up? Now, when we take the same system and we run our trend following system in a per trade risk mode, and then we switch it to portfolio-based risk targeting, we have a drastic increase in total returns. This is a big backtest. This is like from 1970 to 2020. Sharp 0.64, and look at these big drawdown periods, like long periods of getting fucked. With portfolio-based risk targeting, we're at sharp 0.95. We still have drawdowns, but you know, look at this drawdown from here to here. That's a 10-year drawdown. This is a couple of years. So we have this drastic boost in performance. That's free. All we have to do is do things properly. Now, this is kind of technical, so bear with me. What we have is a rolling 6-month standard deviation of returns. So if it's higher, we're getting more returns, and if it's lower, we're getting big returns. Now, the blue line is this one. So you can see that in the good times, the blue line hits it out of the park, but it wobbles all over the place. Got big swings down, big swings up, big swings down, big swings up, big swings down, big swings up. Kind of sucky. The orange line is much more smooth and consistent. Doesn't have the big swings down, doesn't have the big swings up. Has some points where we have the big swing up. And this is interesting to see. We have a big swing up in vola targeted, but down in the other. And where were those periods? Those periods are generally in the drawdown period. So look at this period where vola targeting really, really worked better. Between 2010 and 2015 was the worst period for non-vola targeting. So when you have a drawdown, when you really need it, portfolio-based risk management is much better. So let's look at some real-world examples. So these are some returns on some trend-following hedge funds. Dunn Capital has this incredible return. They turn $1,000 real money into over $1 million since 1970. It's like they've hit it out of the park. Compound return of 17%, Warren Buffett level, better than Warren Buffett. The average drawdown is 36%, and they've had 13 drawdowns greater than 25%, including this bad boy for 63%. This kind of sucks. This is per trade based risk targeting, which is the old way of doing things. This is Paul Mulvaney, friend of mine. I have money with him. I'm very happy with the returns I get from this guy. He does it the old school way. His returns are just under 15% a year now, with 33% realized volatility. But look at the drawdowns. Look at the drawdowns. Look at the drawdowns. He still crushed it. He still crushed it. It's an 8x return in 20 years. I've got $3 million with him now, thanks to the good work that he's done. Very, very happy with the returns, but holy fuck, it's a wild ride. Now let's compare and contrast. This is one of what's called the European trend followers split off into doing volatility targeted trend following. Now you can see that it's immediately much smoother. So these guys did 14% a year with 33% volatility. These guys have traded a little bit of return, so they're only doing 12.51% return, but 16% volatility. So they've traded 1.5% in return for half the drawdowns, half the volatility. The Sharpe ratio has gone from 0.55 in the previous example to 0.81. The maximum drawdown, these guys have 60% drawdowns. The maximum drawdown is 25%. So you can see that the returns are smoother. Now here's another one. This is a Dutch firm called TransTrend. They have a 11.39% a year, but an annualized volatility of 13.98%. And you can see immediately that these guys are just smoother. It's like a smoother ride. So this portfolio-based risk targeting is a smoother, easier to live with ride. And the way that I want you to think about it is that the per trade risk systems, like the Turtles, like Ed Secoda, like Eckhart Trading, like Mulvaney, like Dunn Capital, they're a 1979 Dodge Charger. You know, on the right day, sun shining, the right road, the right music playing, the right girl sitting next to you, there wouldn't be anything better in the whole world than blasting a 1979 Dodge Charger up the right road. But most days, like seriously, most days, a 2023 Porsche 911, that's the smart choice. It's going to beat you around any racetrack. And obviously, our design choices, we've chosen the 2023 state-of-the-art version over the 80s version. And so let's summarize. This is what high-performance system trading is. So instead of using stop losses, targets, trailing stocks, it's much more efficient to use a single variable forecast. It's also simpler to combine many single variable models than to curve fit a model with many parameters. So for example, you could come up with an idea that Mondays are better for your trading system and this hour is better, and we're going to only trade Mondays when the full moon is this and blah, blah, blah. And that's hard. It's easy to wreck yourself. And the easy way to improve returns is simply by adding more models and more markets, not by getting more complicated. More models, more markets, that's the win. And portfolio-based risk management like we use gives far more predictable returns. than trade-based risk. So we've already looked at the results in detail. So let's just continue on. So let's talk about the two types of trading games that we can play. And this is really important. So there's really only two ways you can make money trading. And we have what's called risk premium harvesting, which is emotionally uncomfortable. And we have exploiting price inefficiencies. And this is all going to become clear. And it's also uncomfortable, but it has the disadvantage that it's very, very hard. It's also very profitable, but exploiting price inefficiency, which is called alpha, is hard. Now, the key point is your technical analysis only works to the extent it does one of those two things. So sometimes our technical analysis identifies points where traders are trapped or the market is mispriced. Sometimes our technical analysis identifies momentum, which is a risk premium that we can collect. Now, what do we need to say before we know something works? Like, we can't just produce up a backtest and say, oh, we've got a backtest, it worked in the past, therefore it works. And by work, we mean kind of, what does worked mean? A Sharpe ratio of 0.5 means it's going to work about 6 years in 10. If your car worked like that, you beat the mechanic. So what we're looking for things that work across a long period of time. Preferably should work for 100 years. Should work forever if it's legit. It should work across asset classes. There should be no reason why it works on gold and not on bonds or FX, equities, crypto, commodities. It should work everywhere. If it doesn't, probably shit. It should work in different countries and different markets. If you've got a theory about the stock market, there's no reason it should work any different in an African stock market. Now, it should be robust to how you calculate it. If I'm using a moving average or a breakout, if I have to use one of those two things to get it right and it stops working, then it's probably shit. It shouldn't require special snowflake parameters. The next thing that we should be looking for is that other people are making money for it. That's usually a good sign that we're onto something good, is that other people are getting rich off it. The next thing that we're looking for is that there's a reasonable, logical explanation for it. And we're going to talk about that in a minute. And the last thing that you're looking for, which is very, very important, is that it doesn't work all the time. Every now and again, it should get shat on from a great height. And what I mean is it should not be too good to be true. Anything that looks too good to be true in finance is a scam. It's a Madoff. So let's talk about, of all the risk premium, these are the ones, there's more, but these are the ones with the most amount of evidence. These are the most reliable. So let's talk first of all about momentum, which is what we're doing, which is simply buying the things that start going up and shorting the things that start going down. That's what we do. Other risk premium, selling puts, market crash insurance. You know, on average, people who are buying insurance are price insensitive buyers. Like when you buy fire insurance for your house, you're not trying to make a profit on it. So chances are the guy selling you your fire insurance is going to make a profit on it in the long run. So insurance selling is profitable on average. Now, value investing is another risk premium. Warren Buffett. So on average, buying cheaper stocks is good. And this doesn't really apply to crypto, obviously, because it's crypto. And on average, buying stocks that actually make profits that are high quality do better over time. Like, this is a logical proposition. It's something you can test. It works in every stock market around the world. It works. There's another one called carry, and carry is the amount that you earn if price stays the same. So we have it in FX. We have the interest rate differential between two countries. We have the roll yield in commodities between this futures contract and that futures contract. We have the roll yield in crypto quarterly contracts, and we have the perpetual funding rate in crypto perpetual futures. So all things being equal, investors should prefer things with a yield, and this should be an edge, and we're going to show that it is an edge. And the last of the major one is what's called an illiquidity premium. And this is what private equity works on. So private equity figured out that if you're in a business, if you own a business and you can't sell the business on the mash of a button, that kind of sucks. It does actually suck. Like, it takes you 3 or 4 years to find a buyer for your business. That's a problem. And so a logical, rational investor would demand a premium for being involved in that sort of business. And that's what we've seen. Private equity has performed incredibly well because of that premium. So do these things make sense so far? All right. So momentum and trend, they use the terms interchangeably, is the simple idea that a stock that's gone up has a higher probability of it continuing to go up. Why? We see it in the crypto market, a coin starts going up, and because it starts going up, people sell it less. As people start selling it less because it might go to the moon, there's less sellers, so therefore it keeps going up. More people come in from the sidelines, more people hear about it, it goes on, and it becomes this positive feedback. Now, we have evidence that this has worked all the way back. So we have historical prices of ancient fucking Sumerian grain prices on clay tablets. And if you look at these ancient Sumerian grain prices, put them into a price series, lo and fucking behold, we have momentum way back in Egyptian time. In the 16th century, the first futures markets were in Japanese rice futures. Momentum worked perfectly in Japanese rice futures 400 years ago. In the last 200 years, it's worked in every single market known to man, zero exceptions. And it actually even works in sports betting markets, which is weird because there is no fundamentals in sports betting. So what we see is that when the odds start changing in one direction, they have a statistically higher probability of continuing to change in that direction. There's an edge there. Now, the two best explanations for this are both underreaction and overreaction, weirdly. Now, what is underreaction? So underreaction is that that our brains just can't take into account new realities. So, for example, when the Fed lowered interest rates in 2009, like that was positive for markets, like the markets went up 5% that day. But no one really realized that the markets should really be going up 500% over the next few years. Like we're just incapable of handling that idea in our brain. So we're DNA bound to underreact to the very big things. And we also overreact. So you see at the top of crypto bull markets, we just overreact and we think that it's going to go on forever. In 2001, tech traders expected tech stocks to keep going and going to the moon. And we overreact to recent momentum by getting more and more excited at tops. So it's an underreaction, overreaction. And my point is that because this is built into our DNA, it's built into our psyche. Like I was pretty fucking excited when Bitcoin made its top. I'm no better than anyone else. We're all the same. So the best thing about trend is that when you buy everything that starts going up, you have to own the winners. It's mechanical that if something goes from $1 to $100, and you buy everything that goes from $1 to $2, well, then if it goes from $1 to $2 and you own it, you still own it at $100. You have to own it. The opposite is true. If you short everything that starts going down, you have to be short everything that crashes. So this year, Luna started going down. Our system shorted it. It shorted it all the way to the beach into a shallow grave, re-shorted it, shorted it from like $100 down to a few cents. So you are mechanically exposed to any trends that form. And what this does is it makes it not just robust, it makes it anti-fragile. When the really big shit goes down, when the COVID, when the Ukraine war, when the FTX blows up, you really do well. And so let's look at the big trauma events of the last year. You can see that when we have this Luna 3 hours capital thing, put on 25% in like a week. We were in a drawdown after that, only an 8% drawdown. But when we have this FTX thing, put on about 12% in a couple of weeks. We have the January rally, which started and then fizzled out, and now it's started to work again. It's back up at all-time highs now. But so whenever we get a trend and we don't know when that's going to be, we are mechanically exposed to it. Now that's a good side, but it also sucks. In a practical sense, trading trends sucks us. And I want to be totally honest about this. This sucks. So what it does is it tends to go sideways for long periods of time before making a lot of money really quickly. It tends to go sideways for a long period of time and make a lot of money really quickly, sideways for a long time, making money. And the surest and simplest way to fuck yourself right in the ass is to get cute with this, to say, oh, it's gone up so much, I better add more now. Oh, I'm going to pull my money out. This doesn't work. This hasn't done anything. This is the surest and simplest way to fuck yourself. And do not do this. This is a terrible idea. Do not do this. Do not do this. So this suckiness, that trend sucks. Why are we trading trend if trend sucks? It's something we see again and again with all risk premium. It should suck to earn money. No one's going to pay you to sit in a hot tub and eat chocolate. That is that is a toddler's view of the world. You get paid to take on risk. If someone is going to overpay you to take on risk, there has to be something sucky about that risk. There has to be some reason why someone else wouldn't want to do it. There's only two types of things we can do, remember. We can do technically hard things like high frequency trading or market making or options pricing. We can do emotionally trading things, emotionally difficult things. And trend is emotionally difficult. It should suck to earn money. Trading is not and never will be all blowjobs and chocolate. If you think it's going to be that way, just grow up. So let's look at the other major risk premium strategies that we could choose, and that we will choose some of them. And the takeaway that I want you to take is that they all work. They all suck. Everything that works sucks. No pain, no premium. The premium that you earn comes from the suckiness. So let's look at a selling put strategy from 2007 to 2017, 10 years of it. Gives back about what it earned in 5 years. In 2 years, gives back 5 years of profits in 2 years, and takes 4 years to get back to break even. This is just a shit thing to do. Selling fire insurance, and then there's a big ass fire, you have to pay everyone out. And it makes money very, very consistently and then loses big time. So out of this 10-year period, 6 out of 10 years it worked. That's actually a pretty good strategy. This is not a terrible strategy. You can make money if you did this your whole life, over your entire career. This would be highly, highly profitable strategy. Starting with 100 grand in 10 years, you've made 300 grand. That ain't bad. That's better than most, but it sucks. So let's talk about carry, which is the other thing that we do. We do it with the crypto salary system. So carry is the amount you earn if price stays the same. If price stays the same and you're in a perpetual futures contract, you get paid the funding rate. It works even if you calculate it different ways. If you use the difference between quarterly contract and spot, if you use the perpetual funding rate, it works however you calculate. It is robust. It works over a very long period. It works over the last 100 years. We've got proof of that. It works in bonds, it works in FX, it works in commodities, it works in crypto. That's a good sign, and we haven't found anywhere where it doesn't work. That would be a red flag. And we've got a reason for it. It's not just made up bullshit. All things being equal, people tend to like a return. Now, it has a relatively high Sharpe ratio for such a simple strategy, 0.8 to 0.9. That's pretty good. That's better than trend. But carry sucks. You know, look at here, from 2007 to 2020, you just got back to break even. That is a long ass sucky drawdown. And this is all the G9 FX currencies. So all the currency majors, USD CAD, USD JPY, USD GBP, USD AUD USD, et cetera, NZD. And it makes money very consistently, shits the bed, makes money very consistently, shits the bed, makes money consistently, shits the bed. That's what carry is. Let's look at it in detail on crypto. Makes money very consistently, shits the bed, consistently shits the bed, consistently. But when does it shit the bed? And this is important to understand, is the exact time when it hurts to get hurt. These drawdowns with carry coincide with crypto bear markets. And at the exact time when you can buy 16K Bitcoin and you'd love to have some spare funds, you can't because you're getting fucked. Can you see how carry sucks too? And carry performs pretty well in the long run. This is 10-day carry is a Sharpe ratio of 0.9 in the futures markets, 30-day 0.92, 0.95, 0.93. These are all pretty similar. This is something that I like to see. I don't want to see one good number and the rest suck. I want to see a forest of good numbers. If you could only have one signal, arguably it would be carry. It's mathematically, it's probably the best. Now, value isn't really relevant to crypto because it's all magic beans, but value sucks too. If you're Warren Buffett, the last 15 years have sucked for Warren Buffett. So he's had to see all these idiots buying non-profit making companies that have just gone to the moon, while the old man value stocks like the McDonald's and shit that he has, they haven't done nearly as well. And he had a 15-year drawdown once, and he has to sit through these bull markets where everyone starts writing that Warren Buffett has lost his magic articles. And the moral of the story is that value sucks. And buy and hold is a real strategy. You can just buy it. You can buy the index There's an edge there. Why? Because stocks have an upward drift over time, because society is continually improving productivity and innovation, and this benefits the whole of society, and stocks should go up over time. And we call it the equity rate premium. And it exists because stocks are riskier than bonds. Companies go broke all the time. Over the last 100 years, this equity rate premium is about 4% a year. That's pretty fucking good just for buy and hold. And if you have 50-year horizon, buy and hold is as good as anything. And it works because humans are more afraid of losses than we are attracted to wins. Why? Because in our DNA, back in the day, you break your leg, you're going to die. We're very afraid of losses compared to wins. And companies go broke quite a lot, so people are afraid of it. So a rational investor would want a higher return for investing in companies than for sticking their cash in the bank. And there's an edge there. But buying and holding stocks sucks too, obviously, because right at the exact time that you want to go and buy some cheap stuff, you want to buy a cheap house in 2009, you can't afford to because your stock portfolio has taken it right in the face. Now, I want you to see how the risk premia all suck. Insurance selling, you give back 5 years of profits in 1 year. Momentum, you have a really low win rate and long sideways periods. Equity risk premia, you make money most years, but then in a recession, it really, really hurts to get hurt. And value sucks because in a bull market, McDonald's underperforms Tesla and you've got idiots making fun of you on social media. Harry gives back 5 years of profits in 6 weeks in 2008. So has everyone got this really, really clear that all of the risk premia suck? And this suckiness is the source of the returns. If they didn't suck, everyone would do them and the edge wouldn't exist. So risk premia harvesting isn't trying to identify mispricing, insider information, compete on a battle of wits and speed and technology. These are just doing useful things that suck. Useful things that suck. And so other people don't want to take on certain types of risk. Why? Because they suck. And so they're happy to pay you to take them on. And this is how it works. This is the whole game. You're like a plumber. Your toilet's blocked. I don't want to unblock my toilet. I don't want to go anywhere near that nasty shit. I want to pay my plumber. I want him to turn up promptly, and I'm happy to pay a fair price for him to fix it. And I'll give him a tip as long as I don't have to touch that poo. Other traders are often seeking emotional comfort. Your job is to sell them the comfort they seek. You get paid for taking on risk that other people don't want. Why don't they want it? Because it sucks. There is no pain without premium. None. All right, any questions on that before we move on? That's pretty advanced stuff, guys. No questions? All right, guys. So there's only two types of trading returns. If you strip all of the trading systems that have ever been done and plot their returns on a trade-by-trade basis, they'll either look like this or like this. Skew is the concept we're talking about. So positive skew systems like trend, like buying puts out of the money, have lots of small losses, and they have very small number of large gains with low win rates. Now, negative skew systems are the opposite. They have high win rates. They feel great to trade, but they have occasional large and severe drawdowns where they shit the bed. Mean reversion, buy and hold, put selling, all those are mean reversion. So positive skew systems like trend following looks like this. So this is 14,000 trades on a trend following system in traditional markets from the year 2000 to the present. And so this is zero. You can see that more than half of those are break even or losers. But they're very small losers. Now, in the terms that you guys understand, in R terms, only 3.2% of trades are 5R or better. And only 0.9% of trades are 10R or better. 12.4% are 2R or better, 3.25% better, 0.9% 10R or better. And so what this means is that for a positive skew system, if you cut off this right tail, you got a big problem. The big winners are all that matters. Now let's talk about alpha. Now, alpha is earning money through a market mispricing. You have information the market doesn't know. That could be like Stevie Cohen. He's got some insider information. That could be a high frequency trader who's got advanced information. Could be order flow if you work for an investment bank. It could be mean reversion, price action. It could be some price insensitive trader is being liquidated and the price is lower than it should be. Now, remember, we have two types of games we can play. So the risk premium games are taking on risks that other people don't want. And alpha games are identifying mispricing and being useful by helping nudge price back to where it should be. So if you've got a Kazakhstan crypto exchange and you've got Binance, and you can see that in the Kazakhstan crypto exchange, someone has market sold some tiny shitcoin and it's 10% lower than it should be, you can perform a useful service by buying it and helping it nudge back to where it should be. The advantage of risk premium strategy is that they have incredibly high strategy capacity. There's trillions of dollars earning the equity rate premium, momentum capacity is over $1 trillion, value capacity has almost no limit, and carry is a $3 trillion trade right now. So, but alpha comes from a misprice, and alpha is hard because it's a race to notice it. As soon as you notice it and buy the thing, the price starts moving again. And alpha is hard because it's competitive. Alpha does not scale. Alpha is always capacity strain, and any alpha that you have, eventually it will disappear. So the original FX system that the CSI price action part is based on, if more than about $1 million started trading that edge would disappear. That is the nature of alpha. So some examples of what's alpha is when traders get liquidated or their stops get hit or they're trapped the wrong way. Or you've got some sort of price insensitive selling, which has overwhelmed market maker liquidity. And I'd like you to stop thinking of edges. I like this indicator, I like that chart pattern. I like this type of technical analysis. Edges of service. So there's two ways to do it. You can either take on other people, risk other people don't want, like a plumber, or you can perform a very useful service for markets by helping price discovery, by nudging prices back to where they should be. So this is a philosophical question, right? Like, what should you try and do? Should you try and do this incredibly difficult thing that you're only ever going to temporarily win, that's like a never-ending 1,000-way monkey knife fight, or should you just be a plumber? You can do a little bit of both, and you should do a little bit of both. But my philosophical approach is that alpha capture this should just be the icing on the cake. It shouldn't be your business plan that I'm going to go out there and earn alpha, because someone can take your alpha away from you if they're smarter or better at it than you, or just bigger than you. They can take it. Can't play that game. Risk premium strategies, trend, carry, things of that nature, should be 85 to 90% of your returns, since risk premium strategies don't stop working, haven't stopped working for the last 100 years. And if we think about what the crypto salary system is, it's really carry, which is a risk premium, with just a sprinkle of mean reversion on top, which is the RTV setup is alpha. That's how it works. That's how it should work. Mostly carry, sprinkle of alpha. Right, so I'm going to take some questions now, and tomorrow we're going to move on to our system. I'm going to show you under the hood of exactly how our system works, everything about it, how to use it, how to set it up, how to add withdrawal funds, stop trading, check returns, past and recent real world performance, and how to choose a risk target, because we have this thing, you can choose your own risk target, and how much you can realistically expect to make, and how to get your onboarding slot, which you're all getting for free. So right now, I'm going to stop sharing and I'm going to take questions.
Oh, that was really great. Thank you. Would you like people to raise hands, Scott, and have a chat with you, or just looking in the...
Just unmute and...
Okay, if anybody wants to get on the microphone, I know maybe Paul Nicholson might have a question.
Tom, we're starting with trend. The next one is carry, but we have a very big order development plan, which we're going to go through tomorrow. We've got like 30 things on our list.
Nice. Hey, George, great to see you here. Let's see. Yeah, it was a lot. It was really great, wasn't it? And we'll be able to...
This is a daily chart system. I can run through the evidence for you. I can bring it tomorrow as to how it performs when we lower it from the daily chart on. But the bottom line is that costs become more significant the shorter time frame you go. John, I would say that this system is drastically better than the AWCE and has several advantages over AWCE. The AWCE only works in bull markets. In a bull market, the AWCE will probably outperform. It's also slightly inefficient cost-wise because it's got higher turnover. I would take this one over the AWCE all day, every day. Martin, I probably wouldn't bother trading this with less than $5,000. Kenneth, can we target a portfolio of our favorite tokens? No, that's a bad idea. And here's why. Because you remember, let me share my screen again. I'll show you exactly why. One sec. Okay, see my screen. So if all that really makes the difference is the 0.9% of 10R or better trades, without those 10R or better trades, you're fucked. So when you say, okay, I'm just going to take my favorite coins and I'm going to run it on my favorite coins, you're implicitly saying that your favorite coins are going to be one of these. Is that a sensible bet to take? You might be lucky. You might be unlucky. But keep in mind that without these 10 baggers, your returns are going to look shit. So you shouldn't be taking a list of your favorite coins. You should be taking every coin. If we could trade 500 coins, I would trade 500.
Okay, we got Robert Humphrey's got his hand up here, Scott. So we're
Sure.
just gonna... Hey, Robert, you're on. Hey, Robert, you're unmuted. Good to go. Okay. Maybe Robert will come back to us in a moment. So
let me move through some of these systems. So,
okay.
What was Robert Humphrey's question?
I think he might have had a microphone issue or something.
So there's a question: how would you compare CSI and this, or should they be combined? CSI is a system that's a day trading system that's attempting to earn income. This is a trend following system with hold times of between a week to a few months. It's by definition a longer term system. It's by definition smoother returns, but there's absolutely no universe where you can earn a living from this because we are going to have 150, 200-day drawdowns. Well, so not big drawdowns, you might not lose much money, but they'll have 150-day periods where they do nothing. And this is the frustration with trend following. It is absolutely the opposite of CSI. David, this is exactly what the turtle traders do. Turtle traders do the 1980s version of this. This is just the modern version of turtle traders. And I know one of the original turtle traders. He actually quotes me in his Twitter bio, Jerry Parker. If you look, I was talking to him and I called his trading systems. I said, man, like let's be honest, these things that you do, they're like Tinker Toy hobby level trading systems. And he immediately changed his Twitter bio. If you look up Jerry Parker, who's one of the original turtles, his Twitter bio is Tinker Toy hobby level trading systems. So Jude, do we set the amount of markets? Okay, so this is an interesting question. We have a volume threshold. We can never be more than too much of the daily volume on any given exchange because we could get trapped. And that's in total between all of us. And we need a minimum price history of 365 days. So we're avoiding like a brand new pump and dumps by being conservative and saying we need 365 days of trading history. And so our universe is every coin that passes that filter. And it's slightly different for every exchange. Some of these degen exchanges are going to have 1,000 coins. Some are only going to have 100. Now, smaller coins, more outliers, smaller coins, more slippage, harder to get positioned, less capacity. There's a little bit of a trade-off there. It's not immediate. It's not as clear cut as more is better. In general, more is better, but there's a pro and a con there. Heath, yes, this is designed to complement the current system. Cindy, yes, tomorrow's webinar is recorded. Tom, this is exactly right. The CSI ekes out small daily gains. This is a system that's designed for long-term compounding. Which exchanges are supported day one? Binance and Bybit. Brian, no, this is not working on BTC pairs, but we have a plan to integrate BTC pairs, which I'll go through tomorrow. Clarify the suck. Let me show you. This is very important to clarify how it sucks. This sucks. So this drawdown from here to here, only 8%. But you've had a whole year where you haven't made it, you haven't lost money, taken probably 1,000 trades, and you're right back where you started. That actually sucks. You can say it doesn't suck, but it actually does. You know, Howard, our CIO, was like, how much money did it make last week? I'm like, dude, you didn't like that. It's not, this is a set and forget. And the real magic is in the compounding. So if you are, and all, I'm sorry. Give me 1 second to find this. Yeah, it'll take me too long to find it. But anyway, we'll go through some compounding stuff tomorrow, but the real game of wealth creation is compounding. If you can compound at 30% a year, you're going to end up rich. If you got 20 years, if you can compound at 100% a year, you're going to be rich in 5 or 10 years. It's just about compounding. So this is not, I'm going to pull income out and earn income from it. That is not a realistic thing. Yeah. Shane, does it work to use this over multiple trading platforms? Yes, and that's a great idea. And we're going to talk about that tomorrow. How do you actually execute these trades? It's completely automatic. So we're going to cover it tomorrow, how you set up. It takes 2 minutes. I'm going to set it up in front of you and you're going to see it go. Who do we need the 5K account with either Binance or Bybit to start with? Coach Paul is exactly right. The point is that FinRev is in everything full time. It's adjusting your stake continuously up or down. Timothy, no, there's no time limit. We can work something out. If you just talk to our onboarding team, we'll sort something out for you when we can focus with you. Roy, I probably wouldn't start with 300, just because if you're trading 100 coins, there's minimum trade size on most exchanges, and they have a minimum commission size. So that would make things suboptimal. We've done it with as little as $1,000, but it was a little bit suboptimal there. You could use it with less than 5,000, but I wouldn't go less than 2,000, to be honest. How do you choose the coins? You don't choose the coins, we take all the coins. And the idea is that we're trying to have the humility to admit that we just don't know which coin is going to the moon. Who picked, wait, I picked Shiba Inu, so I can't use that as an example, but really, like, was that a logical thing? No, it wasn't. Hey, Paul Candian, do you have your hand up?
He does, yeah. So I think you should be able to unmute now, Paul.
Beautiful. I got you.
Hey, brother.
How you going?
Yeah, good, man. I love you, bro.
Thank you. If this is a question that can be answered tomorrow, all good. But just with turning up and turning down, I guess the volatility being that, I guess for this next 10 years, I'm about making a shit ton, and then I'll be getting closer to retirement. I guess after 10 years, I'll be looking at the next 10 years retiring. Turning up and turning down volatility to target what your risk threshold is that fairly easy, or how would we?
I've got a very advanced video which I did with the coaches where I was training them. I'm just posting it in the chat.
Awesome.
We're going to cover a lot of that tomorrow. Are the trades and holdings transparent? Oh, absolutely. Everything is public here. Can you use it on a stock index? Yes, you can use it on a stock index. It works on stock indexes, on individual stocks, and blah, blah, blah. But the premium for using it on stocks is, like 3 or 4% a year. It's nothing. You use it on crypto and you're talking 50 to 100% a year. It's night and day. Like it's honestly, everything works better on crypto. Why? Because crypto is newer. Crypto is riskier. A logical, rational investor who's going to invest in crypto compared to the stock market would say, well, I want to invest in stocks because it's safer. But if you want to invest in crypto, you should expect a higher return. And this system is not really for someone who's got enough money to retire and invest in their retirement. If you're doing that, you should do trend momentum, value, or a mix of risk premium strategies in the real markets. If you've already got 20 million bucks, this probably isn't for you, except with a little bit of play money. If you are trying to get enough, if you need 50 or 100% a year compounding, if you want to try and turn 5 or 10 grand into 5 or 10 million in 10 years, with the full knowledge that it's not going to happen on any given day, that it's going to happen with compounding over time. This is a wealth creation program over time. Yes, you can have it running on Binance and Bybit. No, you don't have to have a year of trading. Do we ditch AWCE for this system? Now that's a tricky question because in a bull market, AWCE will kick this as this one's ours. But AWCE is a job. It's annoying. Only works in bull markets. Fees and charges eat a reasonable chunk out of it. I would. On balance, I would, even knowing that the AWC will make more money than this. Bybit for US residents. Janelle is exactly right. A coin has to be listed for a year to be included by the system. We don't want any brand new things that could be a scam or a rug pull straight away. Simon, I don't know the current position with Binance. They won't let you deposit Bitcoin. Brian, yes, you do need to be concerned about third-party risk with exchanges, and we've got a good plan to minimize and eventually remove the risk for that. And we're going to talk about that tomorrow. John, yes, this will certainly work on Woo Network, and that's on our development plan. I'm a massive fan of Woo, as everyone knows. Jerome, yes, US citizens can and are trading on Bybit. And Simon Spall, the eighth wonder of the world is compound interests. Francis, you should keep adding money, but if I would add money when the system is in drawdown, smart play with trend following systems, and in fact all systems, is to add money and draw down if you're sure they're still working. Paul, no, for you guys, you can run it on multiple exchanges. MEXC was on our list, but MEXC has disabled third-party access to their APIs. So that was going to be our first one, but they won't let us do it. And Binance US is a no-go, and they're under regulatory trouble. I wouldn't touch them with a stick right now. Great session, guys. Tomorrow's going to be even better. Tomorrow's going to blow you away. We're going to show you how to set it up, how to use it. We're going to do some projections on how much money you should make. I'm going to teach you how to choose a volatility target. And KuCoin is definitely on the list, Jay. KuCoin is one of my favorite exchanges.
That is fantastic, Scott. Thank you very much. So we can keep the conversation.
All right.
Groups.
The share. Yeah, Laurent and I and Tim on. Laurent, do you have got anything to say, bro?
I mean, this thing is really a dream come true. I mean, this is portable. This is portable hedge fund. This is really hedge fund grade. This has been my lifetime's dream. And what Scott has summarized in a few minutes, in a few words, is really, really, really powerful. Now, I want to come back on the drawdown. The idea of the drawdown. If you could put that one back up. So a bit of my background, I've been in the alternative investment for about 20 years now. So been in a couple of hedge funds. I was working with Fidelity. I was working in the elite group, like we have 30,000 people, and in our group there are probably 30 of them. Okay, so let's go back to the drawdown.
So let's look at the drawdown this year.
Or like, you know, the flat one and the flattish one versus the flattish curve. Yeah, that okay. So my first conference that I did in Singapore, I told a whole bunch of investors that, hey, you guys, you investors, I like teenage girls. Needless to say, it attracted a lot of attention. Yeah, teenage girls, they always say they want to meet a good guy, but they date the same bad boy over and over, every time with a different name. The idea behind this is investors say they want returns, but they react to drawdowns. So teenage girls, they say they want a good guy, but they're attracted to bad boys. And same with investors, they react on drawdowns. Now there are three ways to look at drawdowns. Investors look at drawdown in three specific ways. Number one, magnitude of drawdown. So if you look at buy and hold, you're gonna, or like as Scott said before, the risk per trade method, which is the old school, you're gonna have at some point you're gonna have 30% drawdown, 40% drawdown, and this rule number one, never test the stomach of your investors. This is why the old school trend following, despite having spectacular returns, they fail to attract investors because they fail the first rule, never test the stomach of your investors. Rule number two, like when you have whipsaw, like up, down, up, down, up, down, volatility of returns, never test the nerves of your investors, which means, oh, it's going to be difficult. Yes, it works. No, it doesn't work. Like what's his name? Tom Basso in the Market Wizards as well said, like, my job is to keep investors asleep, lull them to sleep. Rule number three, never test the patience of your investors, which is like, you know, the long drawn out drawdown. This is where people get discouraged. When is it going to go? When is it going to be profitable? When is it going to be profitable? When is it going? And this is where people start to get bored with it. And this is how we're hardwired. Does it make any sense, Scott?
Yeah, totally, dude. This is the way it is. And if you want to get the returns, you have to actually put up with something. There's a, like you know, I'm through bullshitting about this stuff, right? Like here's the reality. Here's what the best professionals in the world can get in their returns. The guys who get paid $5 million a year, $10 million a year to do it. Here's what we think we can do. Here's what we have done. We're in the realms of being very, very good returns, but those returns aren't free. They have a price of admission, and the price of admission isn't always easy to deal with.
One way or another, you're going to have to pay for it. So, there's no free lunch in finance. You've probably heard it over and over. So if you do carry, you're going to pay it exactly as Scott said, like, oh, it works all the time, except when it doesn't work. And when it doesn't work, usually it's game over. Or trend following, you're going to be sitting there and like, oh, small losses, which is mentally, emotionally draining, but it works. You'll never go bankrupt with a trend following system. That's the counterintuitive think about it.
Yeah, so we're going to dig into that a little bit tomorrow, which is that it's almost impossible to go broke with a trend following system because of the positive skew. The other thing that I think is really important is our whole lives we're conditioned to treat drawdowns as like you bet the wrong horse, you chose the wrong stock, you bought a house and your house is worth less. Therefore, you're a dumbass and you're paying a fine. You're being punished because you're stupid and you chose the wrong investment. That is an incredibly harmful worldview and a way to look at it. A more productive way to look at things is you're being charged an entry fee. Like the price of admission is the drawdowns of the price of admission. And what do you get in return for those drawdowns? You get beautiful long-term compound, which is the only thing you can spend, right? Can't spend Sharpe ratio. You only spend money. If you want to take a small amount of money and turn it into a monster pile of money, like Ed Sekoda did, turning $5 grand into 12 million. Well, I think we can do something in those sort of, with a bit of luck and some balls and large drawdowns, if you're willing to take that. I think we can do something in the realms of that. Like we are not fucking around here. All these people that they're shooting for 10 or 12% a year. No, you've got to stake out your claim, and I'm like hoisting the pirate flag here. I'm going for 50 to 100%. And that's just where I am. You know, that's probably completely anathema to the regular, Laurent's clients. Laurent's going to take this to private offices of hedge funds, and they're going to run it at 11 or 13% vol target max. Not me. I'm going to go balls to the wall and make millions and millions and millions out of it.
That's great. And I don't want to cut you off, Scott, but we've taken up a fair bit of people's time this morning. So maybe always leave them wanting more, as they say in
All right.
showbiz. Part two.
Back tomorrow, same time, same bat channel. And Eric, what concerns me is that some experts are predicting a sideways market for years to come. Here's the thing: did they predict the bear market? Did they predict the previous bull? That if you look at any predicting monkey expert, chances are their predictions suck. So if they pick the bear, yeah.
This is where I have to interject and disagree. Like all the pundits and all the market gurus have predicted 39 out of the last 2 bear markets.
Yeah, unbelievable. All right, guys, we'll see you tomorrow. Hey,
Thanks, everyone. Ta-da.
thank you, Laurent. Thank you, everyone.